In this short video, I would like to give you a brief overview of what you will learn in the Nasdaq Derivatives for Professionals course. Futures are the most common and the most liquid financial derivatives. Their importance can hardly be overstated. We start the course by explaining what futures are, how they are used, traded and settled. Once we understand these operational details, we look at the relationship between the value of a future contract and the value of its underlying asset. Understanding this arbitrage relationship is an important step in our quest to demystify derivatives. Futures are very useful because they isolate the risk of the underlying and make this risk tradable as a separate financial instrument. However, futures have their limitations because they cannot break up the underlying risk into an upside and a downside component. For that, we need options. In a first step, we formally introduce option contracts and explain the related jargon. Understanding the pricing and valuation of options is tricky. We start by fostering an intuitive understanding of the dynamics between an option's value and its value drivers. We discuss how volatility, moneyness, and time affect option values. Having developed this intuition, we turn to the quantitative side of option pricing. You will build your own simplified option pricing model and spend time in the valuation laboratory. But don't worry, this is not a math course. We focus on the core ideas behind option models and not on the mathematical details. Our goal is to give you a good understanding of what option models do and how you can use them. Now that we understand the operational and valuation side of the option business, it's time to focus on how options are used in investing and trading. We first explain how investors use options in combination with the underlying asset to reduce risk or generate more cash income. We then introduce the classic pure option strategies that can be used to express market views with minimal capital investments but potentially high leverage. In this context, we will notice that there is an important arbitrage relationship between call and put options. So watch out. When market prices violate the so-called put-call parity, you have an arbitrage opportunity, at least if you are a price taker. If you are a market maker, you risk being arbitraged on your own prices. After that, we turn our attention to measuring, managing and hedging the risk associated with option positions. The risk measures delta, gamma, vega and theta, collectively referred to as the Greeks, quantify the amount of risk caused by changes in market conditions. We explain how the Greeks are calculated, how you should interpret them, and how you can trade away the unwanted risk. In the penultimate section, we analyze the pricing structure of option markets. The volatility skew and the volatility term structure provide information on the relative costliness of options with different strike prices and different expiration dates. We end the course with a brief discussion of American options, that is, options that you can exercise on any day before the expiration date. American call options in particular are very popular in the equity markets because they allow investors to own shares in time to receive dividends declared at short notice. In total, the Derivative for Professionals course consists of 45 online lectures grouped into 10 chapters. Each lecture will take you about 15 to 20 minutes to complete. Each module ends with a knowledge check where you can reflect on the topics and identify areas that you need to review. After you have finished your studies, you can take an online test to receive your course diploma. Note that the course requires only a very minimal knowledge of math, but provides you with enough quantitative support and market insights to have informed conversations with option traders, investors, structurers, quants, risk managers, or any other option specialist. We look forward to meet you virtually in the course. Please contact us if you have any further questions.